When markets start falling and the word recession starts showing up everywhere, most investors do the same thing. They panic. They watch their portfolio drop, they get scared, and they either sell everything or freeze up and do nothing. But here's what the data shows over and over again across every recession in modern history. The investors who kept their heads, stayed disciplined, and understood what was actually happening. Those are the investors who came out the other side wealthier than they went in. This video is your guide to investing during a recession. Not how to avoid the pain, you can't fully do that, but how to understand it, manage it, and use it to your advantage. Welcome to Global Finance Watch. Let's get into it. First, let's get clear on what actually happens to markets when a recession hits. A recession is defined as 2 consecutive quarters of negative GDP growth, meaning the economy is shrinking. During recessions, corporate earnings fall, unemployment rises, consumer spending drops, and investor confidence follows. Stock prices decline. How much do they decline? Historically, the average peak-to-trough drop in the S&P 500 during a post-World War II recession has been around 35%. That's not a small correction. That's a serious, painful loss of wealth on paper. But there are a few things to understand about that number. First, the stock market almost always starts falling before the recession is officially declared. And it almost always starts recovering before the recession is officially over. By the time the news is full of recession headlines, the market has already priced in a significant amount of that pain. This is why panic selling after the headlines hit is almost always a losing strategy. You're reacting to yesterday's news. Second, the decline is almost never permanent. Every single recession in U.S. history has been followed by a recovery. Every one. The question has never been if the market recovers. The question is when, and whether you're still invested when it does. Let's look at the recovery data, because this is what separates investors who build wealth from those who don't. Research from the Motley Fool and market historians shows that the average S&P 500 return in the 12 months after a recession ends is around 38%. The average one-year return from the market bottom, not from the start of the recession, but from the very bottom, is 38%. If you sold at the bottom, you missed that. And historically, most of that first-year recovery happens in a compressed burst of weeks or months that almost no one catches perfectly. Bear markets, defined as declines of 20% or more, have lasted an average of about 13 months from peak to trough. Recovery to new highs has taken an average of around 2.5 years. That's not fast, but it's not forever either. Some recoveries are much faster. After the COVID-19 crash in 2020, the S&P 500 recovered its losses in about 126 trading days, roughly 6 months. That's extraordinary speed, and it caught nearly everyone off guard. The 2008 financial crisis took much longer, nearly 4 years to recover to previous highs. But it did recover. And the investors who stayed invested and kept adding through the bottom came out extremely well on the other side. The lesson isn't that recessions don't hurt. They do. The lesson is that the pain is temporary and the recovery is real. And your behavior during the downturn determines how much of that recovery you actually capture. Now let's talk about what to invest in during a recession, because not all parts of the market fall equally. Some sectors are what analysts call defensive. Their products and services are things people need regardless of economic conditions. During recessions, these sectors hold up significantly better than the broader market. Consumer staples is the clearest example. Companies that make food, household products, personal care items, Procter & Gamble, Colgate, Walmart. People don't stop buying toothpaste or groceries when the economy contracts. Revenue stays relatively stable. Dividends keep getting paid. During 2008, While the S&P 500 dropped 38.5%, Walmart delivered positive returns. That's the power of defensive positioning. Healthcare is another. People don't defer surgery or stop taking medication because of a recession. Large pharmaceutical companies, health insurance providers, and medical device manufacturers have consistently outperformed during downturns. Utilities, electricity, water, gas, are essential services with regulated revenue streams. Their earnings are predictable almost regardless of what the economy is doing. They're not exciting, but they're stable. Telecommunications has increasingly joined this group. In a world where internet and mobile connectivity are considered essential, telecom companies tend to hold up well. These are among the last subscriptions people cancel. None of this means these sectors are immune to losses during a severe bear market. In a full liquidity crisis, almost everything falls. But defensive sectors fall less, and they recover earlier, which is exactly what you want when you're trying to protect your wealth. Beyond stocks, there are other assets that have historically acted as shelters during recessions. Investment-grade bonds are the classic flight-to-safety trade. When investors get scared, they sell stocks and buy bonds, particularly U.S. Treasury bonds. That demand drives bond prices up, even as stocks are falling. A portfolio with some bond allocation doesn't just reduce volatility. In many recessions, the bond position actually gains value precisely when the stock position is losing it. That's diversification working the way it's supposed to. Gold is another safe haven that has performed well during periods of economic uncertainty. It doesn't generate income, no dividends, no interest, but it holds value when confidence in other assets erodes. Financial advisors typically suggest keeping gold at 5 to 10% of a portfolio as a form of insurance, not as a primary investment. Cash has a role too, though a nuanced one. Having a cash reserve in a recession means you're not a forced seller. You're not liquidating investments at depressed prices to cover living expenses. That cushion, ideally 3 to 6 months of expenses in an emergency fund, is what allows you to stay invested through the downturn and even add to your positions at lower prices. This brings us to one of the most powerful recession strategies available to any investor: dollar cost averaging. We've covered this strategy in depth in a previous video, but the recession context makes it worth revisiting. Dollar cost averaging means investing a fixed amount on a regular schedule, regardless of what the market is doing. During a recession, when prices are falling, your fixed monthly investment buys more shares than it would have at higher prices. You are, essentially, loading up at the sale. It sounds simple. It is simple. But it requires discipline, because every instinct tells you to stop investing when markets are scary. That's exactly when the mathematical advantage of DCA is at its peak. Consider this. Someone who invested $5,000 annually in an S&P 500 index fund from 1980 to February 2025 through multiple recessions, crashes, and crises earned roughly 12% annualized. Someone who kept pulling out during downturns and waiting for recovery confirmation earned around 10%. The difference in final portfolio value? Millions of dollars. The cost of trying to be smart about timing? Enormous. Recessions are not a reason to stop investing. For long-term investors who can stay the course, they're one of the best times to buy. Now let's talk about the mistakes, because recessions have a way of bringing out some of the worst investor behavior. Mistake number 1, panic selling. This is the most destructive thing you can do. Selling after a significant decline locks in your losses permanently. You've converted a paper loss into a real one. And then you face the second problem. When do you get back in? Most people who sell during a crash wait too long to reinvest and miss the early and largest part of the recovery. Studies show that missing just the 10 best trading days in the market over a 20-year period cuts your annualized return nearly in half. Mistake number 2, trying to time the bottom. Everyone wants to buy at the absolute lowest point. Nobody can do it consistently. Not professional fund managers, not algorithms, not anyone. The investors who do well in recessions are not the ones who timed the perfect entry. They're the ones who kept investing throughout the downturn, captured multiple dips, and stayed invested through the recovery. Mistake number 3, making dramatic changes to a long-term portfolio based on short-term fear. If your retirement is 20 or 30 years away, a 2-year recession is a blip on the timeline. Rearranging your entire portfolio based on a news cycle is almost always a mistake. Your asset allocation should be based on your time horizon and risk tolerance, not on how you feel about CNBC headlines this week. Mistake number 4, ignoring the opportunity. This is the flip side of panic selling, and it's just as costly. Recessions are when quality assets go on sale. The investors who built generational wealth, Warren Buffett being the most famous example, did much of their buying during downturns, not despite the fear in the market, but because of it. If you have cash available and a long time horizon, a recession is when you want to be buying, not waiting. So what should you actually do with your portfolio when a recession hits or looks imminent? Step 1. Check your emergency fund first. Before you do anything with your investments, make sure you have 3 to 6 months of living expenses in cash that is not in the market. This is your buffer. Without it, you're vulnerable to being a forced seller at the worst possible time. Step 2. Review your asset allocation. Does your portfolio match your time horizon? If you're 20 or 30 years from retirement, you should have significant equity exposure, probably 70 to 90% in stocks, the rest in bonds. If you're within 5 years of retirement, you may want to shift more toward bonds and income-generating assets to reduce sequence of returns risk. A recession is a good time to check this, not to panic rebalance, but to make sure your allocation was right to begin with. Step 3. Lean into defensive positioning within your equity allocation. This doesn't mean selling all your growth stocks. It means making sure you have exposure to consumer staples, healthcare, and utilities. Sectors that can act as stabilizers when more volatile parts of the market are selling off hard. Step 4. Keep dollar cost averaging. If you're investing regularly through a 401k or brokerage account, do not stop. Do not reduce. If you have additional cash available and a long time horizon, consider adding to your contributions. You are buying quality companies at discounted prices. Step 5. Resist the urge to check constantly. The single worst thing you can do in a bear market is watch your portfolio every day. It amplifies fear, invites bad decisions, and adds stress without adding value. Set your strategy, automate what you can, and check in quarterly. Let your plan do its job. Here's what I want you to take away from this. Recessions are not anomalies. They are a normal part of the economic cycle. Since World War II, the U.S. has experienced a recession roughly once every 7 to 10 years. They happen, they hurt, and they end. The investors who come out ahead are not the ones who predicted every downturn. Nobody does that reliably. They're the ones who understood the history, built a resilient portfolio, kept their behavior under control, and used the downturn as an opportunity rather than a crisis. You cannot control when a recession happens. You can absolutely control how you respond to it. If this video gave you a clearer picture of how to think about investing in tough markets, hit subscribe. We cover global finance, investing strategy, and market analysis every week. Drop a comment below. Are you adjusting your portfolio right now or staying the course? I'd love to hear what you're thinking. I'll see you in the next one.